The 4% rule is one of the most well-known retirement planning strategies. It came from what's known as the Trinity Study, a foundational piece of retirement research conducted in the late 1990s. The study was authored by three finance professors from Trinity University in Texas, Philip L. Cooley, Carl M. Hubbard, and Daniel T. Waltz, and published in 1998. Their goal was to determine a safe withdrawal rate, how much money a retiree could take out of a retirement portfolio each year without running out of money over a 30-year retirement period. They looked at historical returns from 1926 to 1995, testing portfolios composed of varying mixes of U.S. stocks and bonds. They ran simulations using different withdrawal rates, from 3% all the way to 12%, and evaluated which strategies survived across rolling 30-year periods. What they found was that a portfolio of 50% stocks and 50% bonds with a 4% initial withdrawal rate, adjusted annually for inflation, succeeded in the vast majority of those scenarios. That result became known as the 4% rule, a simple rule of thumb suggesting that you could withdraw 4% of your retirement savings and increase that withdrawal by inflation each year afterward without ever running out of money. The 4% rule was a revolutionary insight at the time. It gave people a clear, easy-to-understand benchmark to plan for retirement. But it also came with major assumptions: that historical average returns would continue into the future, that bonds would continue yielding 5%, 6% or more, that inflation would remain low and predictable, and that retirement would last about 30 years, not longer. It's important to remember, this study was done in 1998 based on data ending in 1995. That means it didn't account for the dot-com bubble and crash, the 2008 global financial crisis, a decade of near-zero interest rates, or a world where people are now living into their 90s and beyond. Even the structure of the economy and retirement itself has changed. Pensions are nearly extinct, healthcare costs have exploded, and the access to DIY investing didn't exist in the mainstream the way it does now. So while the Trinity study was incredibly valuable at the time, its conclusions are rooted in a very specific economic era. Trying to apply them directly to 2025 and beyond, without considering new tools, risks, and opportunities, can lead to a retirement plan that's overly conservative, or worse, fragile under real-world conditions. That's why more and more investors are looking beyond the 4% rule and turning toward income-based strategies that reflect today's financial landscape. The problem is that the Trinity study was based on a completely different economic environment. Bond yields were higher, inflation was relatively stable, life expectancy was shorter, and the stock market didn't face the same global volatility, asset bubbles, or major technological advances that we see today. Today we're living in a different world. Inflation is unpredictable. AI is rapidly changing the landscape of the world. Interest rates are finally starting to rise off historic lows. Market cycles are moving faster and are more volatile. People's retirements are now lasting 30, 40 years or more. All of these factors and more make the original assumptions behind the 4% rule increasingly unreliable. Instead of relying purely on withdrawing 4% from a growth portfolio, many investors are now shifting toward income-generating investments that produce higher, more immediate cash flow. Let's talk about some of those options. First, real estate investment trusts. Real estate investment trusts are companies that own and manage income-generating properties like apartments, malls, warehouses, and office buildings. By law, they must pay out 90% of their taxable income as dividends. That makes them a powerful tool for cash flow. Many of these funds yield between 4% and 8%, and they offer diversification into real assets, something traditional portfolios often lack. Next, covered call ETFs. These ETFs hold stocks and sell covered calls against them to generate option premium. That premium gets paid out as income, often monthly. Yields can range from 8% to over 20%, depending on the sector, index, and call option strategies of the ETF. The trade-off is you cap some of your upside, but you get reliable income in return. This strategy appeals to those looking to supplement or replace traditional drawdowns. Of course, there are also traditional dividend stocks. Companies like Coca-Cola, Johnson & Johnson, Enbridge, or Realty Income pay consistent and often growing dividends. While yields are usually lower, 3% to 6%, they can offer a reliable foundation. Dividend growth can help offset inflation over time, especially when reinvested. Some people are now generating yield by selling covered calls on crypto positions or using liquidity pools to generate passive income through crypto. The volatility of crypto allows for high premium capture, sometimes double-digit monthly returns. But because of the volatile nature of crypto, prices can swing wildly and the income isn't always stable. Still, it's an example of how high-yield strategies are evolving beyond traditional markets. The bottom line is, the 4% rule was built for a different era in the world. It assumed you'd slowly draw down your portfolio over 30 years, and that inflation would remain stable. But when you can build an income-generating portfolio that throws off 8%, 10%, or even 25% annually in cash flow, you may never need to sell assets at all. Once you start living on the income, not the principal, it changes everything. For many people, focusing on high-yield strategies can accelerate their path to financial freedom and provide more stability than relying solely on long-term market returns with investments that must eventually be sold off. What are your thoughts? Is the 4% rule completely outdated, or does it still have a place in today's investment world? With all of the high-yield options that are available today, I don't see any place for the 4% rule in my portfolio, but that's just my 2 cents. Catch you in the next one.